March 2020 felt like the financial world was ending in real time, and the safest market on Earth didn't feel safe at all. US Treasury trading got expensive, spreads widened, and depth thinned fast. Not because value vanished overnight, but because the exit door narrowed. That's the part most people never forget about a crisis. You don't lose money first. You lose the ability to turn what you own into money quickly at a fair price. A safe asset can do something worse than crash. It can become hard to sell at a normal price right when everyone needs cash. And when that happens, the market stops being a debate about value. It becomes a rationing system for cash. That system has one master switch: liquidity. Here's the core question this video answers, with no predictions and no stock tips. If fundamentals can be fine, why do prices still gap down and why do markets freeze? Why can even the safest corners of finance seize up when everyone wants cash now? The answer is not fear as a personality trait or a sudden failure of intelligence. The answer is plumbing. Bids, asks, balance sheets, margins, and forced selling loops. Once you see the mechanism, panics stop looking emotional and start looking mechanical. Chapter 1. The exit door. Why panic ignores value. In normal times, markets feel like a debate about the future and a story about value. In stress, markets turn into a logistics problem. Who can pay cash right this minute? When many investors need cash at the same time, selling becomes urgent and one-sided. Urgent selling is different from rational selling because it is driven by constraints. That is why panics feel unfair even to smart people who did their homework on value. People expect quality to protect them, but the first question is not quality at all. The first question is, can you convert this into cash fast, at size, without a cliff? Liquidity is the width of the exit door, not the quality of the room you are leaving. When the door narrows, everyone pays a discount, even if the room is still valuable. Economists call this a dash for cash. Selling to raise cash, not to change beliefs. When selling is forced and one-sided, prices can fall below value in a fire sale. Fire sales do not require bad assets. They require many sellers and scarce balance sheets. So the obvious story, prices fell because value fell, is incomplete and often backwards. Value can be steady while liquidity collapses, and the difference is where the crash lives. If you only track value, you miss the constraint that forces selling before value is tested. Chapter 2. The price illusion. What liquidity actually is. Liquidity is not a vibe, and it is not the same as a lot of trading happens here. Liquidity is the ease of trading without paying a hidden tax just to get out of the door. That hidden tax shows up in 3 dials you can imagine on a dashboard of market health. Think of a quoted price like a sign in a shop window. It applies only if you buy one item. If you try to trade at size, the price changes because depth is the real constraint. A 5-cent spread can become a 50-cent spread when liquidity providers step back from risk. Dial 1 is the spread, the gap between the best bid and the best ask at that moment. A tight spread means competition among buyers and sellers is strong and prices are firm. A wide spread means liquidity providers are stepping back or charging you for urgency. Dial 2 is depth, how much you can trade before the price moves against you noticeably. A deep market absorbs large orders with little price impact, like a shock absorber. A thin market forces you to accept worse prices as you sell because real buyers are scarce. Dial 3 is immediacy, how quickly you can execute at a reasonable level without waiting. In calm markets, immediacy feels invisible because execution is effortless and continuous. In stress, immediacy vanishes, and time becomes a cost you pay to reach cash. Now separate 2 words people mix up: liquidity and solvency. They are not the same. Solvency is about long-run ability to pay obligations over time after the storm has passed. Liquidity is about the ability to transact now, at size, without a steep discount. A solvent institution can fail because it cannot access cash when it needs it most. A valuable asset can fall because the market cannot clear trades smoothly today. It is the difference between being right eventually and surviving a margin call today. Here is the cleanest reframe you can carry forward into every headline you will ever read. Value is what you can defend in a spreadsheet and a committee meeting with calm assumptions. Liquidity is what you can get when you must sell on the clock and exits are crowded. And here is the trap. The screen shows you a price, but it rarely shows you the size. A market can look fine for small trades, while big trades reveal the liquidity cost. In stress, the price becomes a range, and the range is the market's way of rationing cash. Chapter 3, the crash amplifier, the mechanism that destroys cash. If liquidity is the symptom, what is the mechanism that makes it disappear so suddenly? It hides in plain sight. In stress, capacity collapses in the middle of the market. Intermediaries stand between waves of selling and the prices people treat as truth. Dealers and market makers absorb imbalances and recycle risk until limits bite. They quote prices, hold inventory, and smooth flows so trades don't move the world. But they can only do that if they can finance inventory and if their constraints allow it. That brings us to funding liquidity. The oxygen intermediaries need to keep quoting. Funding liquidity is the ability to obtain cash, or balance sheet space, on demand. Market liquidity is how easily the asset trades without moving the price much. Funding liquidity is whether the middle can finance inventory and keep making markets. Funding liquidity often depends on short-term financing and collateral staying acceptable. When collateral haircuts rise, the same assets support less borrowing, so cash demand jumps. Stress concentrates in markets used as collateral because they support the whole system. This is why flight to liquidity happens. People prefer what sells instantly for cash. It's not always a value judgment, it's a judgment about short-run survivability. Once you see that, you can separate headlines about value from mechanics about liquidity. Here is what breaks first when stress rises and volatility becomes everyone's shared problem. Volatility jumps, limits tighten, and providers quote less size or wider spreads. Wider spreads and less depth make prices move more for the same selling pressure. That extra price movement raises volatility again, which tightens limits further. Then the invisible accelerant arrives, margin and collateral rules that react to volatility. When volatility rises, margins and haircuts often rise too, demanding more cash backing. If you can't post cash quickly, you sell what you can sell, no matter your thesis. Here's the twist. The easiest thing to sell is often the highest quality asset. Not because it is bad, but because it becomes the system's emergency ATM for cash. So good assets become early victims of forced selling because they are easy to sell. This is where viewers misread the tape and assume selling equals a new belief about value. Often, selling is not an opinion. It is a margin call or a shrinking funding line. The seller is not being clever. The seller is staying compliant with requirements. Now put the loop together, because this loop is the heart of every modern market panic. Lower market liquidity makes prices jump and increases measured volatility across assets. Higher volatility raises margins and tightens financing, which reduces funding liquidity. Less funding liquidity forces more selling into thinner markets, destroying liquidity. This is why liquidity problems spread across markets that look unrelated on the surface. When the same intermediaries face balance sheet constraints, liquidity becomes common. You stop seeing isolated sell-offs and see a system-wide demand for cash and collateral. In March 2020, official support targeted market functioning in key collateral markets. The purpose was not to declare what assets should be worth or to prove a point about value. The goal was to restore clearing and price formation so markets could function again. That detail separates a value crisis from a liquidity crisis in your mental model. If the problem were only value, you would need years of new information to repair confidence. If the problem is plumbing, stabilizing the mechanism can quickly change how markets behave. Chapter 4. Two prices. Value versus liquidity. Here is the model that makes the paradox disappear and makes crashes feel less mystical. Every asset has two prices, even if you see only one number on a screen. Value price. What it should be worth over time, if you can hold through shocks. Liquidity price. What you can get right now, in a crowded exit, under pressure. In quiet periods, the two prices sit close, and that closeness breeds complacency. Spreads are tight, depth is deep, exits feel easy, and the price feels like truth. In stress, they split, and the liquidity price dominates because cash access wins. That is why headlines mislead with words like confidence and sentiment. They imply mood set prices, but constraints can force selling without panic. Even calm institutions can be forced sellers when constraints tighten suddenly. Constraints don't negotiate with value. They demand cash, collateral, and compliance. A panic is often a funding event disguised as a mood, with prices as the scoreboard. Now zoom out to the second-order effect. Systems evolve around what hurts most. If liquidity sets short-term prices, it also shapes long-term behavior and incentives. Products, rules, and habits get built around surviving the funding squeeze. Firms hoard cash to avoid forced selling, even when that cash feels inefficient. Investors prefer positions that stay financeable under stress, not just cheap on paper. Intermediaries ration balance sheet capacity when it becomes most valuable and scarce. So liquidity is not a side feature of markets, and it is not a detail for specialists only. Liquidity is the medium through which prices are discovered, especially when cash is king. It decides what can move, what gets stuck, and what must be sold first. Quiet ending. One question that changes how you watch the next crisis. When someone says an asset is safe, ask 2 questions and listen to the second. First, is it valuable over time if you can actually hold it through volatility? Second, who can finance it at scale when everyone wants cash at once and margins rise? Because in a panic, the scarcest resource is not optimism and not value in theory. It is balance sheet capacity to provide liquidity when the exit becomes crowded. When that capacity disappears, even good assets can crash on the way to cash.